All right. So let's get to it. I think yeah, I'm live and recording. So this is my latest market update, and probably you've already seen on the news with China's new lockdown. Yeah, supply chains are getting tight again, and lately we're beginning to really realize just how fragile the supply chain is, especially now with Shanghai being locked down, and probably soon other major Chinese cities will be locked down. And some of the images that are coming out from there are just incredible because, yeah, we're seeing millions of people just locked down right where they are. There was even one video I saw where it was a group of people who were just locked down in a bus because about 30,000 people have tested positive for COVID. And when you consider a city of multiple millions, it just shows you that China's zero tolerance policy is going to have quite an effect on the supply chains coming forward. And we're going to go through a few charts just to have a glance at what indicators are flashing red. And by red, I mean a recession. So, yeah, quite a lot of US businesses still have quite a bit of work to do in order to rebuild their inventories back to pre pandemic levels. And it's suggesting that GDP growth may have a little bit left, but to be honest, um, there's going to need to be significant amount of GDP growth in order for US retailers to get back to where they were prior to the pandemic. But we've made quite a significant recovery. Uh, but yeah, this drop in retail inventory is mostly to do with the automotive inventory, and that is because the automotive sector has seen it's taken quite a hit from the supply chains. Anything from sourcing chips, because we had the chip shortage in the automotive industry, where companies were trying to source chips in order to put it in their cars, especially when you're looking at electrical systems. And yeah, now we're basically driving computers, and a number of companies have actually shut down their production because of it, or slowed down their production to almost halting their production because they're finding it so hard to source these materials that they need in order to produce cars. So we're beginning to see a lot of, well, this is only from the US data, but a lot of domestic inventories decrease, which is also causing an inflationary pressure on secondhand cars. So sometimes some people are even making a profit on selling their car again, which is just baffling, especially when you consider that, yeah, cars are a depreciating asset. So that is quite a surprise. And considering America is unlike in Europe, here you need a car in a lot of places. You need a car to be able to get to work. You need a car to be able to take your kids to school, and that's just because the nature of how their infrastructure is built is that you need a car. So secondhand cars skyrocketing, yeah, especially in a time where their jobless claims are at a record low. So yeah, they're actually above pre-pandemic levels when it comes to employment in the US, and you can also see that by the pressures on the second-hand cars prices. So yeah, another thing that's also hitting the US retailers, excluding the automotive industry, is their parts for. So this is the same chart as what we saw over here, but this time without the car parts. And what we're going to begin to see is that, yeah, retail companies are going to have to get rid of these inventories. So you're also going to see a number of prices being slashed, and that would also again cut into profits made by retailers because the cost of living is so high now that people are going to have to sacrifice on something. So retailers have to make the price more attractive, which again cuts into their overall profits. So I think it's good to keep an eye on these inventory levels, because I mean, even these inventory levels are much higher than we saw pre-pandemic. So you have higher inventory levels with retailers, and at the same time you have an increase in the cost of living, which means that people have less disposable income. So for the fact that we're hitting records probably not seen since 2008 is a good warning sign. It's also important to look at the freight delivery, because of course we know that since the pandemic there's been a reduction in the amount of lorries that are on the road. So if I actually look at this company data, so according to Freight Waves, what we've seen is that there's been a contraction in the amount of truckloads. So if you think about it, that when you send out a truck, if you're a retailer, you send out a truck, oftentimes that truck would also come back with in the opposite direction with a truckload. So we know that truckers in America get paid per time that they spend on the road, and what we'll begin to see is that they're making a lot less deliveries, and part of that is because inventory is so high, no one is ordering again. So retailers are not ordering again because, one, they're anticipating a slowdown in demand, and two, sometimes it's just too expensive. We've seen the price of gas go up. We've seen the price of freights, shipping freight containers go up, and particularly because a lot of shipping containers are now held hostage almost in China, because they've shut down a lot of their cities and things are beginning to slow down. And since March, we've seen a fall in these trucking freights. So again, beginning to really take into account seasonality. We're entering the spring, we're entering the summer. So we could begin to see quite a contrast between 2021 and this year's figures. And then we know it's no longer about the pandemic, but it's about whether or not people can afford to still purchase certain goods and purchase certain services. So, or even, for example, go on holiday and spend that disposable income, because there's no more disposable income due to the cost of living. Some real signs of weakness is also seen in the ISM chart. So this is what are manufacturers ordering, and we begin to see that there's also a major drop in orders. Probably not seen this sharp of a drop since 2020, and obviously that makes sense because during 2020 there was a global lockdown. And also, we haven't seen this drop since 2008. So, although this figure is from the 1st of April, I believe, that already we should start looking at the ordering figures from manufacturing for May and June. And if we see a significant decline in that, then yes, we are heading for a recession, because manufacturers will not order if they don't anticipate that there's going to be demand. And another one, just to give you an indicator of how bad things are in China. So we know that from the pandemic in 2020, that there was a massive spike in ships that were waiting to unload and to discharge in Shanghai because they had locked down. Now, in comparison to 2022, we are just off the charts in the amount of ships that are just waiting in Shanghai. And that means that the price of shipping containers all around the world goes up because you have this bottleneck of ships waiting in Shanghai. Also, consumer sentiment is down. Probably hasn't been this low since 2010. It's even lower now than when the pandemic happened. But because when the pandemic happened, a lot of people had to work from home, so you have more savings because suddenly you're not spending as much, and so consumer sentiment went down, but it didn't go down that much. But what we're beginning to see now is something that we haven't seen since the 70s, the 2008 crisis, and when people are really beginning to feel like I don't have money. So these are just some of the indicators that are beginning to flash in the background that I feel that perhaps a lot of people are not looking at. I mean, if we, for a moment, go back to some of our charts, if I go back to the economy indicators. So mortgage-backed securities. So this is the MBB. This is a mortgage-backed security ETF from iShares. It hasn't been at this level since 2008. And we know that the 2008 crisis was because people were selling mortgage-backed securities, because these mortgage-backed securities were essentially duds, as shown in the Big Short movie. You had these tranches of things that were AAA, triple B, triple C. However, they were actually junk. So for some reason, people are not buying mortgage-backed securities. People are selling mortgage-backed securities. And even the Fed wants to reduce their balance sheet, so they are also going to start selling mortgage-backed securities. And the same with Vanguard mortgage-backed security ETF as well. So it's not only a significant drop, it's also the speed at which we've dropped. So during the pandemic, there was a sharp drop, but there was also a sharp rally once the Fed announced, no, there's going to be a backstop. We're going to do all we can to support the markets. Now that's gone. Since January, we have just sold off in mortgage-backed securities. And I wish people were looking at this a little bit more, especially since mortgage rates are going back to 5%. I mean, mortgage rates are inverse to mortgage-backed securities. And it has just skyrocketed. And mainly because there's the anticipation that the Fed is going to raise rates. And as a result, we've seen mortgage fixed rates go up. So you can see here the US 30-year fixed mortgage rate is the highest it's ever been. So we've seen this massive surge in house prices caused by the pandemic. So if you have a look here at the US and the Canadian, so this is just after 2020. So I think this may have some 2021 data, but I definitely think for the US market, the home prices are a lot higher than what's in this chart already. And the Canadian house prices are significantly higher. But what we also need to look at is disposable income. And this disposable income is going to take a dip while home prices have continued because of the cost of living. And we still have yet to see the play out of Russia, natural gas, ammonia, fertilizers, like I mentioned in one of my previous streams. But we're going to see a massive reckoning, I believe, of home prices and disposable income. Because especially when you look at Canada, I mean, it is just off the charts. Now, part of that is Canada has a lot of foreign investment into home prices, so it's very speculative, especially in places like Toronto, Vancouver, perhaps even Montreal. But there eventually will be a reckoning, especially as mortgage rates go up. So you can see here, yeah, we're almost back to 2018 level mortgage rates with a higher cost of living, and wages haven't gone up at the same rate either. So not only is owning a home now becoming further out of reach for buyers, also buyers have less to save. And then you're thinking about a 30-year mortgage that's, for a lot of people, half their lifetime that they're going to be paying off this mortgage. So then that also you also have to take that into account as well. But yeah, as you can see from this chart, it's really the 10-year yield that drives mortgage rates. And the 10-year yield has been skyrocketing in anticipation of the Fed raising rates even more. So it's a question of what follows what. And from what we can see from the past, the Fed's funds rate followed the 10-year bond yield, which also pushes the 30-year mortgage rate. So this is why the 10-year yield is so critical to monitor and to follow. If I go back again to our chart, so yeah, you can see the 30-year mortgage rate has also significantly increased since early this year. Having a look at bonds, we can see again we're heading towards 2018 levels for the 10-year bond yield. And we can also see that we've inverted as well. So not only have we inverted between the 2-year and the 10-year, so that is when the 2-year bond yield is above the 10-year bond yield, which means that on the short term, people are nervous. People want to put their money somewhere else. They want to put their money in longer term bond yields until it gets to a point where the 2-year yield is so attractive that people have to buy it again because, well, they need a return. Investors need a return somehow. So yeah, and we're beginning to see it for other markets as well. We're beginning to see, for example, the Italian 10-year yield just break out of its trend and heading towards where the 30 yield is, and that's quite tricky because one of the things that you have to look at, especially with the Eurozone, is the difference between, for example, more stable countries like Germany, because they all use the euro, and you want to look at that credit spread between German 10-year yield and the Greek 10-year yield, for example, or between the Italian 10-year yield, because there you start to see just how disconnected the Eurozone is. And if we have a look at junk bonds, again, like I mentioned probably in a previous stream, begin to see that junk bonds, so these are the high yield bonds, so these are high yield corporate bonds, so these are really the risky companies, and people are beginning to bet, can they pay back their bonds or not? And if there's a worsening economic condition, chances are they cannot pay it back. So that's why you saw in 2020, when you had the global lockdowns, companies were terrified. People will not be able to pay back. High yield corporate bonds sold off like that. But once the Fed said, no, we're going to have a backstop, they rose again. So it's not only the fact that they go lower, it's the speed at which they go lower that you have to be careful of, because when you see high yield corporate bonds in free fall, be scared. And right now, we're not in free fall yet. And chances are we will not be in free fall like the initial lockdown in 2020 because, well, we already have a pandemic. It's not the first time as a global asset markets that we're dealing with a pandemic. We've been there, done that. We've also dealt with 2008. So each time you need to have a more scary scenario. So I think the global food shortage could be a really scary scenario, especially now that we're seeing countries like Peru, Sri Lanka, where people are taking to the streets and protesting. So Could it be a commodities crisis? And this has been my guess recently that we could be heading into what we call a commodity crisis. Yeah, so that's it for the junk bonds. You can also see for some of the other high junk bond ETFs. This seems to be the case. So these are all the things that I tend to monitor when I'm looking at recessionary indicators. You can also see there's quite a disconnect between, well, apart from today, there's quite a disconnect between the VIX, which is the equity volatility, and the bond volatility, which is much higher. Usually they move in lockstep because when the bond markets are volatile, chances are the equity markets will begin to become volatile. But what we've seen is a disconnect as of late. And if we look at the Nasdaq, which is taking an absolute beating because of the anticipation of higher interest rates, which means that high growth companies, which the Nasdaq is composed of very high growth companies, are getting hit, and they're getting hit badly. As you can see here from my chart, when it's in the green zone, these are the good times. So these are the number of Nasdaq stocks which are above the 200-day moving average. And you can see in 2009, these were the good times for growth stocks because chances are these companies were already hit heavily by the dot-com bubble. And you can see December 2020, 2021, we were just having a good time when it came to growth stocks because everyone was anticipating a fast recovery, low interest rate environment. I mean, you've probably heard of companies like Fast, which have received just crazy amounts of funding with very little revenue to show because people are just betting on whatever horse is going to win. However, as it stands now, we are now in the correction zone for the Nasdaq, and anything lower than 13% of stocks above the 200-day moving average is when we need to get scared because then we're now heading towards 2008, 2009 levels. And I think it's important to monitor the Nasdaq. The Federal Reserve and other major central banks have not stopped quantitative easing. So for me, if it's below 13% of Nasdaq stocks above the 200-day moving average, for me, that's the economic crash zone. So you may want to start looking to see the companies that you think can make it, especially a lot of these tech companies which are eating up other industries. They may be worthwhile buying in the long term in these zones. And then you have what I call the unknown zone. So that's something that we don't know. And obviously, I feel like it's almost impossible for an index to have, minus 10 stocks above the moving average. But in this economic crash buy zone, that's when we need to start looking at, okay, what companies within the Nasdaq in the long term are going to make it that are disrupting key industries. So think about health, think about law, think about things that we use every day that in the long term, this tech company is going to transform. And you need to start accumulating because, we're beginning to see some companies minus 70, minus 80, minus, 85. They're not all bad. They were highly overvalued after the Fed began quantitative easing because of the pandemic. But some of those companies are still incredibly valuable given the technology that we have now. So it's important to keep an eye out for that. Another one is the Russell. So again, I have these key levels, which I think for me is worth buying at right now. A lot of the companies within the Russell, so these are small cap companies, they tend to be laden with debt. So the fact that they're laden with debt means that they could go down even further. So for me, I'm looking at below 10% of all of the Russell stocks before I start looking. Okay, maybe it's time to start looking at the key stocks within this indices that you can buy, especially with small cap stock, because once economic conditions begin to improve, we can start to see. And again, you don't know how long below the 200-day moving average a lot of these companies can be. Right now, value seems to be holding up quite well. But I think once you begin to see even value stocks decrease, so the Dow is made up a lot of value, and also if you have a peek at the S&P, they tend to be, because they also encompass not only just high growth tech stocks, they also encompass, your energy, your utilities, everything we need to live daily. However, it's good to set your level and then start to look to buy into some of these indices at these levels. So I'm not only a market bear, I'm also very bullish to see, okay, when can I get in, especially with the NASDAQ hitting really critical levels that it hasn't hit in a very long time. I'm beginning to look at companies, beginning to look at sectors that, these sectors are not going anywhere anytime soon. And in fact, we're going to need them even more as economic conditions worsen, to cut costs, to optimize, etc., etc. Okay. One thing I found was quite interesting to have a look at is, if I get back to my candles chart, is the US dollar and Japanese yen. So what we know about the Japanese yen is the fact that investors tend to buy the yen as a safe haven. However, for the fact that the US dollar and Japanese yen is so high right now, it means that actually people are buying the US dollar as a safe haven. And I think the US dollar could continue to get stronger for a longer period of time. And this is because the BOJ is printing, and they are printing like there's no tomorrow. They have what I call infinite QE. And the Dixie already crossed quite a crucial level. It's hit 100. So we've gone all the way from 89 to 100. And in comparison to the pound, the euro, which is taking, some serious hits, the Canadian dollar, even the Aussie dollar, I still personally believe the Aussie dollar can go down quite significantly, especially if the housing bubble pops in Australia. Because the housing bubble, you think the housing bubble in America is bad, or in the Eurozone is bad, the housing bubble in Australia is horrific, in my opinion. And and the RBA has no intention of raising rates anytime soon. Chances are they may raise it a bit earlier as the cost of living bites and inflation, and they are mandated, like most other central banks, to bring in some price stability. But I can't see the Aussie dollar being valued very high anytime soon. And I think the only thing that's keeping the Aussie dollar up is the fact that they have key minerals that we use. They have their lithium, their iron ore. But then, for example, with iron ore, if construction slows down in places like China, because China's housing market is plummeting, which means that more inventory is coming onto the market at a cheaper price, there's less incentive to build more houses. Chances are the Australian dollar will also be impacted by that as well in the long term. The euro, I think the only thing that is in the Eurozone's way right now is the war with Ukraine, and the fact that Europe needs an alternative for Russian gas. And only then, when you begin either some form of peace negotiation turns out with Ukraine and Russia, or they find a magical formula to produce energy that doesn't require Russian natural gas or any Russian entities. the pound, coupled with Brexit and the fact that the UK is facing just incredible cost of living prices, something needs to change because I cannot see the pound getting stronger, especially against the dollar, anytime soon. As you can see here from the cable, GB and US dollar. So yeah, that's it from my stream today. I think there's a lot of indicators that we need to keep an eye out for. Also keep an eye out for good buy levels for companies that you think are solid, and will be growing or needful in the future. High dividend stocks are also something you should have a look at, because during this time you need things that are going to give you some form of ROI or some form of yield. Anyway, that's it from me. Good luck.